Awesome. Yeah, I'll just give a quick intro. My name's Say. I'm a fourth year student at Northeastern University. I'm also the strategic director of NU Impact. We're super excited for this conference today and really glad to everyone who's made it out here. I see about 87 participants like right here in the chat. Just want to let you guys know there's a little Q&A tab. Throughout the session, feel free to put in questions that you have for the whole panel, for all the panelists. However, we'll probably have that session happen towards the end of the panel. And I know we're going to have Willow take over and start the moderation for this panel. So super excited for this topic. If you have any questions, feel free to leave it in the chat. And also we'll all be around. So if there's any issues, Willow, just feel free to call us up. But I'm going to leave it to you. Thank you, guys.
Okay, great. Let's get started. This is the Future of ESG Investing panel. Our aim today is to give you all a sense of the landscape of ESG investing and talk about key developments and regulation in the field. This is a field that I'm relatively new to. I'm in the first year of my career, so I'm really excited to discuss this with our amazing panelists. So quickly, Mitali, could we start with you? Could you give a brief introduction of yourself and your work?
Thank you, Willow, and I'm excited to be here at the panel again. This is my second time, and obviously virtual this time versus being in person, a couple of years ago. So great job, for all of you guys to, organize this on a virtual format. So a little bit on my background. I'm a portfolio manager in the ESG field. I've had 25 years of experience in investments and portfolio management. I work at Trillium Asset Management, and Trillium is actually one of the oldest investment firms devoted exclusively to sustainable and responsible investing. And ESG kind of is a new term that has been, kind of getting more, into the news media more recently, but Trillium has been doing this for over 35 years. We have over 4 billion in assets under management. And we are really differentiated kind of from a lot of firms in this area by basically being active investors, where we engage with our clients and, with the companies to really bring about social and positive change, on various issues along environmental, issues, social issues and governance issues. And, we can get into that in more detail as we go through this panel discussion, but just wanted to put that out there. Thanks.
Could you give a brief introduction?
Sure. Hey, everyone. Thanks for joining, especially on a Saturday morning when it seems to be fairly nice out here in Boston. And so thank you for taking the time. My name is Andrew Drosty. I'm a board advisory specialist. Specifically, I specialize in ESG markets, ESG investing, and really it's responsible investing, it's sustainable investing, etc. There's so many terms that I'm sure we'll talk about to have in your lexicon, but nevertheless, my job essentially is to audit boards in behind the scenes. And so they are our clients, Fortune 500 type companies. We go in, we take a look at what management practices and processes look like and what board oversight processes look like when it comes to overall board effectiveness. And that, of course, includes, thematic ESG oversight, how it's actually being integrated into the business, and whether or not, management, including the board, are kind of competent on the material ESG or sustainable issues that the business is facing. And so we essentially go in and we offer advice from that standpoint. Prior to Russell Reynolds Associates, I was at Bank of New York Mellon. So I led their ESG advisory work there, engaging with portfolio companies on behalf of ESG issues that we had, again, thematic issues, engagement priorities, and also ESG voting for shareholder proposals there. And then prior to that, I was at Nuveen Asset Management, which formerly was TIAA CREF. And I was on the responsible investing team there. So I'll stop there.
So much, Andrew. I'm very excited to speak with all of you. And then Nelson, if you'll wrap us up.
Yeah, sure, absolutely. Good morning. Thanks for all for being here so early. Name is Nelson Chu. I'm the founder and CEO of Cadence, We are a securitization and infrastructure platform for private credit. And so as part of ESG, there's a lot of elements of that that are actually impacted or affected by private credit as an asset class. These are things like renewables. These are things like, it depends on how you define it, small business lending, emerging markets, things like that. And so it is a pretty broad coverage here, and we support the syndication of all of this debt to the people who need it effectively. So we've done about 400 million-ish, give or take, since we launched the platform in mid-2019. And we have a lot left to do for this year, at the very least. But excited to be here and speak with you all about this topic.
I'll just briefly mention I'm Willa Hubert. I work at Boston Common Asset Management as an ESG research associate. So I think we talked about this first question a little bit in our introductions, but what is your thesis for ESG investing that you utilize in your work? Are there specific KPIs that you look at? How do you think of this, how you work? Anyone feel free to jump in.
Hi, Willow, thank you. I can start off if that's okay with the rest. Yeah, I mean, in terms of kind of how we look at ESG, metrics, etc. I mean, for Trillium, for each of us as analysts and portfolio managers, we, fully integrate ESG work into our fundamental analysis. So we look at various KPIs, which is key performance indicators across different industry groups. And the way it works is that typically for us, we break it down by, different sectors. And then within different sectors, we break it down by different industries. So depending on the industry so if I look at, for example, I'm also an industrials analyst there. So if I'm looking at industrial companies, there are certain metrics that I would apply for those. So I'm looking at companies which have products that actually, either bring out energy efficiency or help in resource conservation, etc., which are metrics which are very different from what I would be looking at if I was a consumer staples company, where suddenly, the raw material chain and kind of the ingredients that go into the supply chain actually make a big difference. So depending on the industry, the KPIs and the metrics that we look at vary. I think one thing that is common across all our different industry, the ESG work that we do is we are looking at governance. That is an important factor that we look at, across the board. So within governance, for example, we look at things like, board diversity. And, pretty much up till now, you would find that a lot of companies have really been focused. If they are focused on diversity, they're looking at gender diversity. But, now with some of the racial, ethnic kind of diversity issues that have been coming up, Trillium itself has been working with companies on trying to make sure that we are motivating them or catalyzing them to also, start at least looking at racial and ethnic diversity within the board, and then kind of trickling down into the management level and the employee base as well. So again, those are factors that would be common across the board. Social factors, again, depends on the different industry group, but we're looking always at, what the employee relationships are, what the supply chain management is within the, different companies, etc. How the company interacts with its community. And I think some of those metrics, again, will vary, and the weight that we put on those metrics varies by the different industry groups, but it really becomes a part of how we integrate all of those metrics into our fundamental analysis. And that's where we kind of really add value by looking at some of those metrics. It's just not a rating system that we look at. We do our own proprietary analysis as well.
I think for us, it's a little bit broader because our mandate is so wide. We actually cover all things private credit, right? So that could be things like factored receivables for a granola bar company. It could be a small business lending opportunity to a specific region. And so it really is it's just a conscious decision on our side to be able to focus on and make ESG a priority across the board in the different companies that we work with, to be able to provide them the debt capital they need to be able to grow and scale. And so when this company first started, there definitely wasn't a specific ESG mandate per se. But for us, we realized that obviously not just the opportunity in the emerging markets, but also the actual ability to do well and do good in the world. It's the reason why we've made ESG a priority. And so Latin America is a huge focus for us just across the board in terms of being able to provide capital and banking for the underbanked populations. We've done work in Africa as well. And so all of that it works out well in our favor to be support those regions in being able to get them the capital they need when the banking system as it exists today isn't really doing that great of a job and probably won't for the foreseeable. Be dependent on companies like us and startups like us to be able to do that effectively. And so we've been able to provide it for Colombia, Mexico, Africa, many different countries in Africa. And it's been really rewarding for us to be able to do that. But also, again, depending on how you quantify or classify ESG, during COVID, we were tremendous and did a great job in helping small businesses all around the country being able to get back on their feet through the different originators that we work with to be able to get them the loans they needed to get that approved. And more importantly, not cut the lines of credit that they may have had, where a lot of other companies did. And so that was a great win for us, and all of the companies we work with at the high level, at the originator level, pretty much made it through COVID and were able to continue to operate to support the small businesses and consumers that needed it through that process.
And lastly, I'll be quick because we're not investors, right? And so our integration of ESG issues is slightly different in that it's not coming from the investment side of things. It's mostly coming from the pressures that companies are feeling or clients are feeling with regard to their major institutional investors, and usually that includes the BlackRock, Vanguard, State Streets of the world, including Fidelity, et cetera. And what their priorities are. And so our integration is really from the module standpoint where when I was brought on by Russell Reynolds from Bank of New York Mellon, my task was to integrate ESG issues into their existing board effectiveness framework and modules, existing ones that they already had. And so my task was to build out ESG specific ones. And so I've done that here. And in doing so, I've integrated, frameworks such as SASB, which is industry specific and related mostly to the investment side, and is really focused on materiality, as well as GRI, SDGs, et cetera. And so the idea was always to integrate existing frameworks and standards in which to come up with what would be bespoke to the client's issues. And I think what's really helpful from my side is that because we sign non-disclosure agreements, et cetera, we're able to kind of look under the hood and see whether or not, for instance, management is handling ESG issues and integrating it into their enterprise risk management processes, so their ERM processes, in addition to reporting in an effective manner through KPIs and dashboards to their boards. So we take a very broad aspect when we're looking at integration of ESG issues. It's very specific to the client that we have in that moment. So.
Yeah, and from my experience, I know integration can be a huge challenge. It's one thing to have the information available. It's another thing to utilize it. How do you all think about that in your work, creating true integration across your teams?
Yes, hi again, I'll jump in here. Again, as I mentioned, at Trillium, we've been in this business since 1982, and I think the way it evolved was historically it was much more kind of, I would say, values-based in some ways, but more and more as time has gone on, there's definitely more positive impact that is being created. So as we think about how we integrate it, for us, as I mentioned, in terms of doing the analysis, for sure, the analysts are constantly being, there's no separate ESG analyst team that does the work and then gives us names to look at or stocks to look at. As an analyst, I will be engaging with the company, talking with them about, just as I question them on fundamental due diligence, financial details, I will also question them on ESG details. So to us, it really starts from that bottom kind of fundamental work that is done around both, the financial side as well as the ESG side on the due diligence part of it, right? And then in terms of kind of moving along the way, in terms of actual integrating and really trying to see how we can make an impact, we also have a very active shareholder advocacy group, within the firm. And so what then happens is that for companies that we invest in, I mean, no company is perfect, even if they're, ESG leaders, there's always changes to be made. And there are some other companies that are still lagging behind in terms of, what they're doing and, whether within the company in terms of disclosures, as I mentioned on the diversity side, representation, etc. So we then kind of identify areas that we need to engage with, with companies on, and that then kind of starts that whole dialogue with the company that starts, maybe even earlier on in terms of when we're just doing the analysis with the company, but then really continues even once we own the company in our portfolios to really engage with them and bring about change. And some of it can go through, there's different avenues of shareholder advocacy, and I'll leave that for a later point in the discussion. But, that's to us, that's an integral part of kind of what we do. Is just not the investment side of it, but kind of follow on engaging with them and just bringing about some positive change, across different metrics, within those companies that we invest in.
An amazing model, and I think integrating ESG from the bottom up is probably crucial to making it actually part of the work you do. Mm-hmm. I'm curious to hear about your work, Andrew. How have you, I know I've heard a lot about the lack of ESG knowledge on corporate boards and this kind of deficit in true understanding. How have you tackled that problem through your career?
Yeah, I without being too cynical or pessimistic, that's one way, especially on the investment side when I was on the investment side, but in particular now when we're interviewing both named executive officers and board members, the key questions that really suss out whether or not they have integrated it and whether or not they have that level, that competency when it comes to material ESG issues to their business strategy. It's really simple questions as to kind of doing your research beforehand, looking at what they disclose from a binary standpoint of, yes, they disclose GHG emissions. Okay, if they do, is it only scope 1 and scope 2? Do they disclose scope 3? Asking kind of nitty gritty questions like that to board members for me has always been enlightening, because I think that if they get it, then they absolutely know what I'm talking about when I ask the question of, do you think that, investor pressures are getting to a fever pitch where you're going to have to not only start tracking scope 3, but then also disclosing it. And if that question completely goes over their head or they look insanely quizzical after, I immediately know that at least this board leader, and usually we're dealing with either the chair of a board or we're dealing with the chair of a Nom and Gov committee, for instance, because Nom and Gov is kind of the de facto kind of ESG purview committee at this point across the S&P 500. When the board leader doesn't know kind of how to respond to a specific ESG question, and I know that the company discloses it or management discloses it, that's how I know whether or not, they've truly integrated it into the, management versus kind of board oversight connection. And in order to have an effective board, you need to have a very competent board. And in this day and age, when BlackRock, the largest asset manager in the world with, over $8 trillion assets under management, has integrated at the end of last year ESG issues across all of their portfolios because they see enhanced risk-adjusted returns in doing so, then every single company needs to be aware of what their particular material ESG issues are. Because, for instance, BlackRock, likely their largest investor or top 5 investors, are very much focused on this, and they are going to needle them, I think, in engagement priorities and in the proxy voting process. And that has increasingly over the last 10 years, with the aggregation of assets under management of the top 5 asset managers, has been increasingly important, I think. When they lose a say on pay vote or a shareholder proposal passes on deforestation, for instance, that's front page news now, whereas before it really wasn't, because it wasn't necessarily happening. So I went in a few different directions there. I'll stop.
I guess I could chime in. Because this isn't directly related to what we do from an integration standpoint, because for us in general, It is just about data, right? So we are the ones providing capital to these various different companies who then provide the capital to the people who need it and the companies who need it. And so for us, as long as there are cash flows there to be able to support any type of investment product that we create off of it, then we can basically securitize it and syndicate it out and structure it. So for us, the bigger challenge is really around even being able to get this data. So in the emerging markets in particular, obviously in the US, it's a lot easier. There are almost like alternative data sets to look at. When you think about extending loans to individuals in emerging markets, they don't have banks, right? They don't have credit scores. They don't have anything like that to be able to underwrite against. But they do have various different things that they pay for on a regular basis, whether it's mobile phone bills or things like that, that we're able to then use to see how the lender has been able to quantify the performance of that specific individual or that specific company. And so our requirement is effectively to be able to get that information on a daily basis to then be able to justify any type of product that we create off of that we can then syndicate out. So it is a little bit different. Our angle is more, is this an ESG type asset class or an ESG type opportunity that we can create, but the actual underlying data is the same across the board for every type of company that we work with. If they can get us the data on a daily basis, if they can get us cash flows that we can underwrite and securitize against, then that in and of itself becomes interesting and we can actually work with them.
Bringing up emerging markets, Nelson. I think that's an excellent kind of area that we can continue with. I know we all have diverse work streams, so if we could just speak on that theme generally, maybe how you think about KPIs differently in emerging markets and how your work in that area is evolving.
I guess I can start right back there again. So for us, it's definitely quite a bit more complicated. There is, obviously we have legal counsel here that can work on all things like US related, but we usually have to retain counsel down wherever country we may be in to be able to support that, because we're just not familiar with not just the legality, but also how the government and the governance works over there. And so it usually doubles the cost inevitably when we do it. But for us, at the very least, the spreads in emerging markets in terms of yield is a lot higher over there than it is here, and versus here it has narrowed quite a bit. And so you're able to basically, from our users' perspective, from our investors' perspective, make up the cost that it takes to do it by the spreads that come out of it. So it ends up being a wash, and it's okay. It's not the end of the world from getting it up and off the ground. In terms of, I would say, just the complexity of that as a whole, like I mentioned, it's the data is a lot murkier sometimes. You would expect that, at least. But I would say that there's been a change in how these companies operate in these emerging market countries, if only for the fact that a lot of them are these are startups that we back generally. These are founders who got their MBAs in the United States. They used to work in investment banking, and then they went back to their home country to be able to actually provide and create financial services startups down there or wherever they are. And so in that regard, they are much more keen on using data to their advantage. They're much more keen on creating technology around it. And so we found that oftentimes the technology wherever we're working on an emerging market country is on par, if not better, than what we have in the United States. I think that the US is almost like taking it for granted, and it's the baseline, so it's fine. So I'm here, so I should be able to get whatever money I want. In the emerging market countries, they know that they're almost like up against or being compared against the US or anything like that in terms of chasing capital. And so they know that they have to get a step above, and the step above is through better data, faster data, and getting more comfort around the underlying investment, ultimately, so that they can get the capital that they need. So we actually found that outside of the legal, everything else is very easy to work with, and oftentimes better than the companies we work with here.
Willow, I can address it from kind of the investment side of the equation. And again, it's, as you pointed out, on the emerging market side, definitely in terms of the ESG, availability of the ESG data, disclosures, engagement, it's all a lot more complex and, depends. And, I would say that even in the US, for example, it's still an evolving field in some ways in terms of what the standards are, what the disclosures are. So you can imagine the emerging markets are even, few steps behind that. For us, most of our strategies are domestic, but we also have global portfolios. So our emerging market exposure tends to be minimal. But there are companies, again, within that who recognized that, this is kind of a growing field, and that, are more responsive in terms of whether it's talking with the analysts or engaging with our, teams, and in terms of disclosures as well. So, those are the kind of companies we end up owning, but just on an aggregate, definitely kind of still lagging behind. And that kind of makes it a little bit more critical. Back in the day when things were still open and we could travel, some of our analysts would, make trips to those emerging markets. Really being able to meet with the management teams, etc., would kind of get you to that one level ahead in terms of transparency. Again, it's something which is still evolving. I do feel that as we kind of are looking at this space, just overall, I think Andrew alluded to it to some extent, companies like BlackRock, etc., which have, huge amount of assets under management, they have all kinds of strategies that are investing in emerging markets, etc. And as that kind of drives, as that motion kind of continues in that direction around the ESG, really recognizing the value of ESG, I would expect to see some of those emerging market companies also, becoming a little bit more transparent in terms of disclosures, etc. So yeah, that's all I had.
And I'll be quick. We're mostly focused on domestic companies here in the U.S., but we have dealt with Brazilian companies, Canadian, and Japanese here. But on the investment side, yeah, I mean, we dealt with emerging market portfolio companies often. And in fact, I mean, there are some countries that are actually, talking about, I think the disclosure and regulatory standpoint are in fact a little bit further ahead, although, Japan isn't an emerging market by any stretch of the imagination. Their level of integrated reporting, for instance, and integrated reporting is really kind of a side by side. You've got your normal kind of GAAP measures, balance sheet type stuff, integrated with things like social capital metrics or natural capital type metrics, and it's integrated really into kind of one report. There are many companies in certain markets that this is standard. This is par for the course, where you're integrating and measuring and disclosing these ESG type metrics into your financial reporting. So that's one thing I'll say. I'm not as knowledgeable on emerging market type companies by any stretch of the imagination, but I'll stop there.
Really interested in what's happening from a policy perspective. Lots of emerging markets, China, for instance, one of the largest economies in the world, has set a net zero goal by 2060. So I'm very interested on how the policy will interact with ESG disclosure as this all evolves. So if you don't mind, maybe we can shift our discussion over to the policy and regulatory side. What are you seeing come up? What do you think folks that are looking to get into this field should be aware of?
Again, I would say, I'm jumping in, sorry here, but in terms of, I think, policy side, we've definitely seen an evolution, like in everything else, but in this case, it seems to have accelerated in the last, I would say, 3 or 4 years, around kind of what's going on in that space. As Andrew alluded to, I think some of the countries, and again, these are not emerging market countries, Europe, for example, is way ahead in terms of kind of how they're thinking about ESG and disclosures, etc. So they already, starting, I think, March this year, they have their whole new way of, regulation, like reporting, basically disclosures, the SPDR, I think it's called, I'm trying to remember, sustainable financial disclosure regulations. There's a lot of alphabet soups kind of within this space. So, but yeah, so they have that. We have our SASB, which we still haven't really kind of standardized as yet. It's out there, but we really haven't. But I think that's where the market is kind of moving towards, that whole ESG investment space. More policies coming from the top, this is kind of government mandated. You mentioned China. They're definitely moving along in terms of, putting out mandates, and they want, whether it was semiconductors a few years ago, electric vehicles right now, disclosures and, kind of moving into that direction as well. So definitely, I think some of these countries, because it is kind of government mandated, can move faster on some of these things. And the US has to kind of actually, I feel, catch up in some ways. I think we are way behind Europe. We're still trying to catch up. I mean, Europe also has their SDG, there are the UN SDG goals, etc. So a lot of the European portfolios, and we do have a European, team, etc. So some of those portfolios are very much aligned in terms of their investments to the SDG goals, for example, the Sustainable Development Goals, etc. Right? And I think so that whole space continues to evolve, and I think you'll continue to see more standards kind of being applied, and those standards becoming standardized, because right now it's like there are different, there's SASB that some people may look at, there are other disclosures that other people are following. There is no one way of looking at, ESG investments right now. Even in terms of ratings, for example, is the same thing. Everybody has a different set of ratings. So an MSCI will have a different set of rating for the same company versus, Sustainalytics versus, something else. So I think that's the other part of whether it's through policy work or, the standardization part of it is what really needs to kind of, for the next evolution, the next step in the evolution, I think that's where we need to be, is more of that standardization around and, policy-driven work as well.
And Nelson, sorry, I'm gonna budge real quick. I think that, listen, in 10 years, I don't think that this term ESG, right? It's used ad nauseum at this point, and I think that in 10 years, it is going to be table stakes in any investment portfolio because of the aspect of enhanced risk-adjusted returns. Because of that, we're going to see more thematic type investing that's based on certain, whether it be social criteria or environmental criteria, or whatever it may be. But you have you're going to see such a consolidation when it comes to standards and frameworks on ESG and sustainability more broadly in the next 2 years, probably, right? I mean, they're all talking with one another. Whether that be, integrated reporting, SASB, CDP, TCFD, et cetera. I mean, they're all trying to talk to one another to come up with a standard framework. And IFRS is a good example too, how they're putting together the International Financial Reporting Standards. International companies use these standards in which to report in all markets around the world. I think that there will be hopefully a standard definition at some point, that leverages, for instance, the EU taxonomy that you had mentioned. But I think in 10 years, this is just going to be table stakes. It's going to be in accounting classes. It's going to be in business schools, law schools, etc. And it's going to be, they're going to look back and then they're going to say, how did you not measure and disclose this on a quarterly basis? And so I think the original question was, what should the students be looking out for? It's really just understanding that this is a complete sea change as to, a shift away from this Milton Friedman idea of maximizing shareholder returns to something completely different, whether you want to call it stakeholder capitalism. Really, this is just risk is risk, right? And so, sea levels are rising, climate change is creating havoc on our societies. And so that is an inherent risk that I think every single company needs to account for on their balance sheet in order to have, well-adjusted price discovery of assets, et cetera. So I'll stop there.
I think, Will, you brought up something interesting around China in particular, but because they're a unique offender of this, but they have obviously a fantastic push towards renewables and all these different goals that they have set for themselves from an ESG standpoint, but they need to balance it out with monetary policy as well. And so we've worked on a number of deals in Asia and China in particular, where yes, like it is definitely, very, very progressive, very modern, all the things that you'd want to expect and come to expect. China doesn't really have as much an issue with this as other countries would because of how big they are. But there are also a lot of hesitation to invest in China, period, because you can't get your money out. And so there is a big problem with around the fact that they will be self-sustaining, and China can do that. But other countries need to make sure that they don't fall into that same camp, because while they may be interested in it, investment into initiatives that the BlackRocks of the world are interested in and want to push for, and they think that's an easy win for them. If they don't have the monetary policy around support the entire ecosystem to make this effective, and also have the governance and the oversight to be able to ensure it actually gets put to good use, all of that means that it's going to be really not all that successful. And it's the reason why we've backed out of China altogether, just simply because we don't have confidence that the investors that we have would actually be able to get their money out, and that we can actually see and understand that what they're saying is actually true and not just a total like house of cards. So it all needs to kind of go work hand in hand. I don't think it's quite there yet, and a lot of countries are in the same camp from my perspective.
Yeah, that's really interesting. I know China has turned worms for a lot of investors. Mitali can probably attest to that. We've had a lot of internal discussions at my firm around our role in China. So I think that's an area that will continue to be evolving over the next year as well. I wanted to kind of get back to this point of there is no standard measure of ESG. There's no one number, Sustainalytics, MSCI, it's all different. How do you respond to those criticisms? And we talked about regulation. What are some other ways that you think this work can be standardized, made legitimate? Yeah, thoughts on that?
So as you know, I guess, so the way we look at ratings, I think just to back up a little one step here, is that the way we look at ratings is kind of just a starting point. You know, you just get some numbers, you just get some facts from that. And at Trillium, for example, we do say that we do all our proprietary, materiality work that we do on any sector. It's all kind of our value add, right? The ratings just give you, it's like, I think if you look at credit rating, it gives you a little, one kind of a picture. But I think when you really start digging into why those ratings are what they are, and look at how they're it could be they're looking at slightly different KPIs, or they're giving them a different weight, and maybe how we think about certain things. We, for example, right now think that racial ethnic diversity on a board is really important, and an MSCI may not be looking at those metrics at all right now, right? So their weights will, come out differently, that will affect the rating, etc. So for us, it's just a starting point, and then the value add really comes from the work that we're doing. I think I go back to Andrew's point that I think it's this field as it's evolving right now. You will start to see more standardization. I don't know how that happens, but I think more and more companies are talking about it. They're looking at, I think there are certain things which are being accepted as, standard disclosures, the greenhouse gas emissions, how do you look at the carbon footprint for these different companies, these equal opportunity statements, which do we have gender reporting on those, and do we have racial ethnic reporting on those, board diversity, so I think just some of those metrics kind of as investors start asking for that, as companies like ours, start asking for that, I think you'll start to see a little bit of that standardization just come about organically. And then, there will be, some policy driven changes, or, I don't know who the governing bodies are, but they, making changes along, on those ends. But from our perspective, the way we use ratings, like I said, it's out there. We, don't subscribe to every single one of those rating agencies, but it's a source of information, and that's what data, basically, that's what we use it as. And, that's how we are kind of looking at it right now. But I mean, I think it'll become a part of it. It's my hope, again, as Andrew said, that in 5 years or so, it will be just fully integrated into what we do. Just for, for example, right now, we don't question metrics like, what is EV to, enterprise value to EBITDA, and why do you report on cash flows, and why do you report on returns on invested capital? I think it'll be just another like, let's see your carbon footprint. Let's see, what your gender, those will be just metrics that are part of the standard disclosures. So hopefully there are people like, who are working on some of the standardization, but I think there's a lot of it which is going through organically as well. And at Trillium, I will say, we do engage with the customers and on a policy level as well, and we kind of collaborate with other firms. So, for example, with the Boston Common and some of the other larger firms as well, our advocacy teams will be then engaging with some of the policymakers on driving some of these issues as well. So hopefully you continue to see that evolution along that way.
Yeah, I think a lot of it really always, I guess, in this capitalistic economy, it comes from people who have the money. And so when ESG first started, like this was a while ago, or when it was first kind of becoming a thing, the returns were not that great. Like, for example, like solar, right? When you first started solar investments, it was very average, if you will, in terms of how much you'd be able to get off of that from making an investment, but you were doing good for the world, and so you thought that would be okay. These days, ESG investments have either outpaced or at least equaled other investment opportunities. And so if that's the case, there's going to be the expectation from the investor side that the data becomes a lot more clean and a lot more standardized, so they can start to make comparisons across different investment vehicles. And so you're seeing this big push, and to Mitali's point, it is organic in a lot of ways because investors are asking. And so now we're at the stage where the data has never been easier to collect. The demand for data has never been greater. There will just be a natural push towards that because of the ability to get the outsized returns on ESG investments is there. It's going to make for a lot of investor clamoring to be able to get that to make it happen.
And yeah, I mean, I think both of you put forth, I think, a great picture. There's not a ton to add other than to say that ESG is not a monolith. Most investors now are leveraging, for instance, a Sustainalytics, an MSCI, whatever it may be, not per se for their rating system, their own methodology. They're leveraging it in which to scrape data, which is unstructured, which is something that they can then use as some sort of an overlay data-wise across their investment classes. And so I think it's important to note that because ESG is not a monolith and there's no standardization and definitions yet that every single company is using, most of this disclosure and data, again, like I said, is completely unstructured. And so it's really up to the investor to determine how and what the weight is of each one of these data points. And if you look at the top 50 institutional investors, I would imagine, I'd wager that at least 75% of them have their own thesis and methodology in which to apply ESG and how they define it. And so and that's what's setting them apart from other asset managers, which is why it's not a monolith at this point. And so listen, ESG rankings at this point are becoming so important and so material that I'd imagine that it's going to go the way of credit ratings, and it's going to be regulated within the next few years here, because it has to be, and because it goes to the point of greenwashing, really, right? This is a term that I'm sure you're going to hear a lot of in the next year, because last year was the year of ESG and outperformance and all this other stuff. Well, now you're going to see a bunch of companies, and we see it now with the beginning of proxy season. A ton of companies are including communications now that have ESG in it, right? And it was exactly like with blockchain. We saw a few years back when a company included a quote, of blockchain in any one of their financial reports, their stock price rose a certain percentage point, right? And it's the same thing with ESG at this point. It's something that is without a doubt one of the most important issues of our time. And greenwashing is going to be pervasive, and it's something that we have to look out for more broadly. But I'll stop there.
Will definitely be an issue for the day. I think Nelson touched on it. I hear a lot of great stories around different disclosures and KPIs that are driving positive financial return. If you could give a sense of some of those examples that you like the most for the audience, I think those are a great way of hammering the point home of the value of ESG investing.
So you're talking about like specific metrics that we look for in particular, or?
Yeah, I think it could go either way, either in disclosures, KPIs, or what are some indicators that you see as driving the most positive financial return?
Yeah, I think it's interesting. So we go very, I would say, almost like macro or take a more holistic view of things. And so we have a huge thesis on Latin America as a whole in terms of the fact that there's just not that many banks that support these various different countries versus like the US has like several thousand banks. I think Mexico in particular has like 26 or 23, something like that. And so there is a lot of opportunity there. And we're looking for specific, for example, lenders who can provide capital to the underbanks, like we mentioned. And so there's not one specific metric that we look for because at the end of the day, they ultimately just look like lenders and they are lenders. But it's how do we get that data out of them and are they supporting the country or the local economy or whatever it may be in a way that's very beneficial to the people. That's what we look for ultimately, right? And so in what we talked about, ESG as a whole is table stakes in the future, and it's just gonna be part of everything that we do. I'd like to say that we're pretty kind of in line with that in the sense that as long as there is a opportunity that's doing good for whatever the country that it's in, and there is an opportunity because of the existing financial system being so broken, then we find that to be valuable. And so that's the reason why Mexico has been a focus, Colombia has been a focus, Africa as a continent across the board in many different countries has been the focus. And we've also seen the ability to actually support local economies and local businesses there. So the originator that we have in Africa, which goes through a couple different countries, is there to provide power sports financing or motorbike financing, which here you would imagine it's like some guy wants to finance his Harley. Over there, it's a little bit different. It's going to be actually that they are using it to be able to support the local taxi economy or the local delivery economy and things like that. And so it's a fantastic initiative, and those originators have done well because investors recognize that they can do good and do well at the same time, and that's what they really are a fan of. So I would say there's no one hard defining metric as long as they're again as a lender, if they are a good lender and all those traditional metrics you come to expect, then the natural side benefit or ancillary benefit is the fact that it does wonders for the economy over there.
Worth noting too, Willow, I think that the SEC has already determined that regardless of sector or industry, what they expect in 10Ks, for instance, is some level of disclosure around the management processes as it relates to human capital management. And so that's one, for instance, KPI that I would underscore, that the regulatory bodies have already integrated into mandatory compulsory reporting for domestic companies here in the U.S. And so it's worth noting that this idea of quote unquote human capital management has already made its way, I think, into the fore of this is material to your organization. Please let investors know how many employees you have, whether or not you have employee engagement surveys, what is the EEO1 diversity makeup of your workforce, of your board, whatever it may be. What are the different strategies? How does it relate to your actual business strategy? How do you integrate that? Do you have employee resource groups, etc.? All of these different data points makes up ESG as well. But just broadly to the point, my original one is that KPI of human capital management or employees as a stakeholder being material to the bottom line has already made it into financial reporting, which is a good thing.
And I was just going to add that, yes, besides these, issues that they've addressed already, I think as we are thinking about kind of what, KPIs make a difference, I think I look at it both from, kind of what is the revenue. There are certain KPIs which could be revenue drivers. There are certain KPIs, if you start thinking about the costs and the risks, there are some of those which impact those areas if I'm thinking of just, a particular stock and a company, right? So for revenue drivers, I mean, some of the KPIs we think are important. And again, I mentioned in my space, for example, looking at companies which really have sustainable products, right? Now, it could be, like I said, environmental efficiency or energy efficiency, resource conservation, organic, natural foods, etc. So there are certain products. So that could be, if you could look at that as a revenue driver and say that will drive growth, for this company, just because that's where the the customer base is gravitating towards, naturals and organics or environmental conservation. And then on the risk side of it, are a whole lot of other factors that we look at, right? It's supply chain management and, how sustainable is that supply chain? I mean, there are issues around palm oil. I mean, there's a whole slew of issues that kind of come up along the way, how those companies manage their raw material sources, and if they have other sub-suppliers, how are they managing those suppliers? Are these companies, do they have subcontractors in other countries where they may be giving out bribes, or which happens in some of these kind of developing markets, emerging markets, right? Those are all risk factors that you have to take into account. So to me, those are also KPIs that could impact your investment decision. So I think it kind of, to single out a couple, I think human capital management, board diversity, just diversity across the, some of those things are for sure very important. And we, like I said, we look at those KPIs across any single investment that we do, but there are others that kind of just impact certain areas, both on the risk side as well as the revenue side. And I think that's where the ESG integration part of it really kind of comes in, and really understanding what those issues could be. I mean, I know before I kind of was really thinking about ESG investing, I did not know that there was a whole issue around bee pollination, right? And there were certain pesticides and things that were being used that impacted the bee population that actually had a impact along the way, so on the ecology there. So I think there are a lot of issues where the ESG expertise really factors in, and I think some of those KPIs, I don't want to minimize some of those, because I think those will continue to be important as well. And I think, like I said, it's it's for an individual stock level, but also kind of just climate overall, or environment overall, kind of how are we thinking about the planet that we live in, and how do those KPIs impact some of those broader issues as well. So that's how we think about it's at different levels, and just hoping that we're all doing the right things and making a positive change, across the board, and in various different ways.
Yeah, I think that's a great point. And we've talked a lot about KPIs today, but in reality, the work of an ESG analyst and the work that happens in this field is quite diverse. So I'm hoping to end with other work streams that you deal with in your job, perhaps the proxy process, shareholder advocacy. I know we're a little bit diverse here in our sectors, so I think it would be wonderful to share how these different work streams, whether it be shareholder advocacy, the proxy process, interact with the work that you do, and how you think about ESG.
So I can start off here, but in terms of kind of for us, all of those things you mentioned, proxy voting, shareholder advocacy, etc., we think of as kind of one comes under the broader umbrella of company engagement, and how do we kind of factor that in. And I think one of the ways we've realized that in terms of making a positive change within those companies, in terms of whether it's reporting or changing their practices within their operations, is through this engagement. And we start off, like I said early on, with an analyst conversation, just as we're talking to the company, but then it moves forward. And if we believe that there are areas that need to be improved upon, or that they need to kind of be addressing, one of the ways we do it is just kind of conversation with the company. And that kind of very often will, kind of yield positive results for companies who are already thinking along ESG, kind of, being the ESG evolution. Proxy voting, as you mentioned, is kind of another way to kind of let the company know that this is how the shareholders think. So voting against, board members that are not as diverse, or, climate change kind of things that may impact climate change, etc. Those are all things that we believe can, help put that intention out. And the more shareholders who are able to do that, and sometimes in proxy voting, again, we will collaborate with other companies to make sure that other investors who are like-minded are thinking along the same lines. And I think that is evolving, and people like BlackRock, etc., who are now just larger companies, once they start doing that as well, it just kind of moves that needle much faster. And then the other part of it is also shareholder resolutions, where if proxy voting is kind of a passive way in some ways of putting that point across, but shareholder resolutions, this is for companies that really are not engaging with you in a conversation. Proxy voting hasn't worked. We will put forward shareholder resolutions which then got voted upon, at their annual shareholder meeting, etc. And that again gives a further push and at least lets the company know that there is this, the shareholder base that is kind of interested in some of these metrics and that they need to move along. It's non-binding, so it doesn't mean that the company will act on that. But typically a shareholder group then kind of, advocacy group will engage with the company, have conversations. There may be policy work that they end up doing. And that kind of drives, that process forward. So to me, it's more of a collaborative process. And, there are different steps to it. It's layered. It's a layered approach. You kind of do, you hit the company in different ways. I don't mean hit, but, kind of address some of these issues in different ways and kind of continue to move. I mean, the way we look at it is this is a partnership with the company. I don't know if the companies look at it that way. We think of it that this is how we're going to make positive change. And like I said, the leaders in that ESG space will really engage and welcome our feedback as well. So I think those are the companies that, you would see kind of as, being kind of, further ahead in terms of the ESG evolution.
I guess for us, we are still like a 30-person company, and so it's not like there's a lot of difficult decision making that needs to be made. It really comes down to kind of within ourselves, what do we want to focus on, and what is the almost like the moral compass that we want to follow here in terms of what we ultimately offer to our investor base, right? And so it's really very much at our discretion. There's examples when we first got the company started where we had lots of different lenders come to us saying that, hey, look, I can get you 25% annualized returns. Don't worry where it's coming from. Just like trust me on it, and it'll just all be fine. And so in our heads, we're thinking, okay, so if you're offering us 25%, that means you're probably charging like 150% if that's the case. And so that was just, it didn't sit right with us, right? And so it was a decision by us to be able to ultimately say, we don't want to work with people like that ever across the board. That there was a bit of, I guess, just feeling justified coming out of all this, because a lot of the ones that we had spoken to during that time for offering us those opportunities ended up blowing up during COVID, because there's no way where you can sustain your business by doing something like that in a scalable way or when events like that happen. And so we're proud of our track record. We're proud of everything we've done since then. But it's just something that we instill into not just us at the management level, but even at the individual team member level, to be able to just really do the right thing above all else and have integrity when you do things like this. And it's worked out well, just based on our performance and based on how we've been able to navigate some of these, what we'd like to call bad actors, at least in the industry. And there are no shortage of them.
So from my specific standpoint, my knowledge of what's going on during proxy season, for instance, or what happened during proxy season, if it's after proxy season. And actually to explain that real quick. So for those on the conference call, right, proxy season is where the vast majority of US issuers have to issue their annual general meeting, their definitive 14A, which includes ballot items related to, directors, shareholder resolutions, right? Including say on pay proposals, the ratification of the auditor, et cetera. And because most US companies follow a calendar year when it comes to their reporting, they inevitably end up within a 3-month time period, all filing for their annual general shareholder meeting within that time period. And so long way of saying that's proxy season. And from my standpoint, when I am, I geek out on proxy plumbing stuff and shareholder resolutions and things of that sort, so much so that I'm literally tweeting about it on weekends when I should be doing something else. It's so important to our clients because the companies that are smart track this type of stuff to determine, okay, what is the issue of today? What's the issue then of tomorrow? Because shareholder proposals end up being, from an intent standpoint, really, what's on the horizon. So most companies try to fight it through the no action process at the SEC, it's called. I won't go into what that is, but essentially the company can say, we don't want to include this on our annual general shareholder meeting ballot. So we're going to go through the administrative process first to determine whether or not we can exclude it. long story short, these shareholder proposals that end up on the ballot, even if they don't receive an enormous amount of support from shareholders, they can actually be an early indication that there is an issue, and a lot of them are related to ESG issues, that there is an issue either at the company or within the industry. And if you can track those over time and in the moment, even before the vote is had or after, they may withdraw it because there's behind the scenes, they come to an agreement. But they're gold. And honestly, it's free consulting for the company, as I like to tell my clients, is that, if you get a shareholder proposal related to some ESG issue, it could be that the analysis from an objective standpoint is trying to get you to understand something that maybe you don't understand as a management, or related to your business strategy or oversight or whatever it may be. And so it's free consulting. And so from my standpoint, what I want everyone to do, if you want to geek out also on this type of stuff related to your original question, Willow, go to proxypreview.org. Every single year they release, proxypreview.org releases this report. It's an amalgamation of all these different investors and NGOs that put together essentially a report on all of the shareholder proposals that will be presented at companies within that fiscal year. And so take a look at it. It's lengthy, it's extremely substantive, and the data in there is it's absolute gold. So I'll stop there.
We got to touch on some of those work streams. They're very interesting, and I think they really speak to the future of the field as well. If we have a moment, maybe we can answer Richard's question in the chat. The question is, do you think US policy will hold companies accountable against greenwashing? Do you have a sense of this timeline?
Can you just repeat it below? Actually, I didn't.
Yeah. Do you think the US will bring in policy and hold companies accountable for greenwashing? If yes, do you have a sense of the timeline?
Oh, I wish.
No.
But I don't, I guess that's kind of the difficult thing, right? Is how do you prove, the greenwashing? And I think it's we, for people who've been in this field for many years, we've definitely looked at it, kind of the recent slew of investment firms that are coming up and saying we're all doing ESG, and kind of adding that ESG name to their fund name, and kind of getting the globes from Morningstar. This is how they do their rating, etc. So definitely it's out there. I don't know if there is a policy issue that will kind of allow us to step in and say, okay, this company is doing greenwashing or not. I think right now it really comes down to individual investors or clients, if you're looking to buy a fund, to kind of really dig in behind the scenes. I mean, again, as retail investors, you don't get to do that. Institutional investors do get to do that. Figure out really how companies are, investment firms are integrating and applying ESG values to their investment, decisions. I think that's the important part. I don't know how the policy, I wish there was. Not quite sure if it'll, end up that way or not. Andrew may have a better idea, if there is something going on in the horizon to do that. But it's something we've, at Trillium, I'm sure Boston, we've all discussed, right? That it's, there are larger, bigger firms who are out there saying that they're fully integrated ESG managers, which we know they're not right there. So I'll leave it at that.
It's got to be so frustrating for you in particular, right? I mean, you started off the conversation by being like, I've been in this space for decades, and my firm in particular has been here for decades, and so I think that you're exactly right in that. I to the question, the short answer is I have no idea. No one knows. But I do think that the administration that we have today is very much focused on this. Over the last few months here, there's been a sea change at the regulatory or in the regulatory environment. I mean, the SEC now has an ESG page, right? And it's, at the end of the day, greenwashing is really just lying, in my opinion, right? And so whether that's from the standpoint of an investor saying that you're applying this across all your portfolios or whatever it may be, if you're not really integrating it, that's greenwashing, and in essence that's lying, and that's hurting, I think, the retail type investor that decides to, as an asset owner, transfer their assets over to an asset manager. because you're getting a raw deal, right? I mean, if you think that you're in an ESG or sustainability ETF or other investment vehicle, you expect, I should say that you don't expect that, for instance, they're going to be investing in certain companies, which again goes back to the broader point of how the hell do you even define ESG, right? And that it's not a monolith, and that there are different investment strategies and theses across different firms. But long way of saying, to answer the actual question, I have no idea from the regulatory environment. I think I'm positive about it, whereas I'm not very positive about many things, I feel like. But I do think that there's going to be something here on the horizon here in the US that looks somewhat similar to the EU standards that have been put forth, like the taxonomy or SFDR, et cetera. So I'm hoping it's coming, because the SEC's job number one is to increase transparency for good price discovery, and so that investors understand what they're investing in. And right now, investors don't understand what they're investing in when they put their dollars into an ESG or sustainability ETF, and it's because of greenwashing. So I'm hoping that from the regulatory standpoint, something's on the horizon here.
I was just going to add that yes, it's definitely on the investment funds firm side that there's greenwashing, but companies themselves can also be doing greenwashing. So that's really important to think about, that they all know, so they'll put out the press releases, they'll put out an ad campaign that kind of makes it sound that they're kind of on top of things, but then internally, when you go into the processes, how they're managing people, operations, etc., you realize that they're not practicing what they preach. So I think that's kind of the other thing to keep in mind as well.
Yes, no, you're absolutely right. Yes, without a doubt.
Oh, this is a little farther out from what we normally do, so I don't have a ton to add on that. But I think just in general for us, because our companies are a lot smaller, it's our discretion, right? And so we do the diligence and we do the research to ensure that they're not actually lying about what they're doing. And a lot of that comes from the data that we track and aggregate. And we have a proprietary data set for ourselves that we use to quantify a lot of these investment opportunities. And so that's what we focus on. US policy-wise, even if the US does come up with policy or doesn't come up with policy, it doesn't necessarily change our objective here in being able to provide solid performing investments across the board that have the reporting that you wouldn't normally come to expect in our specific asset class, which I would argue is more and better than most.
Great, and I think with that, we'll wrap it up. So Mitali, Nelson, and Andrew, thank you so much today. This was a really interesting discussion. I think we covered a lot. Thank you for your time.
Thanks, Willow. Thanks everyone.
Thank you, everyone. Thank you so much.
Happy Saturday. See you.